Bitcoin is digital capital. So it's the transformation of financial and physical capital to digital capital. And that's not complicated. That's a very simple idea if you just say it like that. But the implication is it's also driving the digital transformation of the capital markets. So the capital markets are fragmented, right? The bond market trades in Japan at different times than the bonds trading in Germany, and then the bonds trading in Brazil, then the bonds trading in the US. And the equity market, right? Our existing capital markets are built around equity and debt. And there's some derivatives, right? Equity, debt, and derivatives, and they trade 9:30 to 4 Monday through Friday, and they don't trade on the weekends, or they don't trade on holidays, and they're all fragmented, and they're limited in access. So the implication of somebody being able to trade in a capital market in Australia on Saturday and having an impact someone in the United States, 12 hours off on the time zone or something. That's interesting. So a real-time 24/7 global capital market is interesting. Up until now, it has been, again, it was 0.01% of the money in the world, when it was 6,000 or 7,000 a coin. And now it's 0.1% of the money in the world. And so it is a global digital capital market, but it's still de minimis in amount of capital. And so I think that as you see bigger players come into the marketplace and it gets to be 1% of the capital of the world, now you're going to have the tension of the 20th century. The 20th century capital markets, they're fragile, they're limited to a certain set of people, there are very limited settlement options, they're slow, they're not smart. You can't trade Apple stock 100,000 times on a Saturday afternoon, right? So you can't vibrate it at a high frequency, you don't have you can't self-custody, you can't program it. Right, so the capital that's in the traditional markets, it's not programmable, it's slow, it's fragile. And the capital in the 21st century, it's going to be smarter, faster, stronger. And so the interesting opportunity is what happens when the investment bankers and the commercial bankers and the money managers realize that digital capital is smarter, faster, stronger, universal. Right? Because it has a lot of implications, right? Like there's 50,000 publicly traded companies, and how many of them are capitalized on Bitcoin? How many of them are capitalized on bonds? So 99.99% of the corporate capital is financial capital, which is fragile, fragmented. Bitcoin is the risk-free return for a Bitcoin maximalist. So just start there, right? Bitcoin is the risk-free return. And the question is, do you want to take risk or not? But if we start with my base case is the risk-free return is 29% ARR for 21 years, which means that when you pitch me an idea, if you come to me and say, hey, I got a new Bitcoin custody thing, or I got a new hardware wallet, or I got, a new Bitcoin whatever banking thing, or I got a new whatever. I'm like, well, so can you guarantee me 29% plus the risk premium, which is probably 8%, 6, 8, 10%. It's like the risk premium on a mega corporation like Disney or whatever is 4 or 5%, and the risk premium on a small startup has got to be 20%. Okay, and so if you pitched me an idea and said, okay, I guarantee you 40% ARR for the next 21 years, and I'm like, and is it going to be capital free? Like I don't have to bother with it, and I don't have to put any more money in later. Like, well, if you promised me all that stuff, I would like, okay, well, let me think about it, but probably if you gave me 10 of those ideas, I probably still don't want them because it's just a distraction, because my view is 29% ARR risk-free. And then I guess I would say when you look at it like that and you compare it to the next 50,000 publicly traded company ideas and the next 500 million private ideas, it's like they're all kind of distractions, with the exception of this, which is the only thing that's better than Bitcoin is more Bitcoin. Okay, so what is my personal idea? My personal view is like, my personal holding strategy is, I own Bitcoin. You know, I'll either hold the asset, 17,732 Bitcoin, you know, which I tweeted, you know, 4 years ago, which I'm still holding, or I would hold like the ETF if I needed to, you know, to buy, if I had extra cash flow yesterday and I just wanted to have it, and I thought, well, I don't know if I can hold it for a decade. I might need to spend it in 2 years to pay some expenses, but I'm going to hold it for now. So if I'm trading in high frequency in and out or whatever, you know, it's like, you know, I would buy an ETF of Bitcoin, and I would take the counterparty risk to BlackRock or Fidelity or something. But you know, would I put my Bitcoin with Celsius, you know, or BlockFi or FTX or Genesis? They all pitched me, by the way. I already said no to every one of them. No, 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 no. But why? Because the counterparty risk to an unregulated entrepreneurial custodian is like 25% a year. Like they're going to fail every 3 years, right? So, I mean, just rationally thinking, and I just don't need the headache. So if you offered me 40%, well, I mean, think about this, right? If you thought you've got 25% counterparty risk and your risk-free rate is 29% over 21 years, you're already up to the point where they have to offer you 55% interest to put your money in their custodian, right? So did any of them offer me 55% interest? No. And by the way, if they did, then my next question is, well, how are you going to generate 55% interest? Well, we're going to like put it in a DeFi levered protocol on what? I'm like, okay, well, no. Now I've got like towers of counterparty risk. You know, that's like 7 layers of risk. And eventually there's a degenerate trader, you know, offshore in a dark pool that's levered up 20-1 that's paying that. So none of those things are very compelling. So I would say those don't make any sense. But, you know, on the other hand, like if JP Morgan offered me 5% interest on my Bitcoin and they pledged their balance sheet, too big to fail. If they said JP Morgan won't back it, if they said, we'll take your Bitcoin, we'll loan it to someone who wants to short it, and if they short it, then you're out. I wouldn't take them as a broker, but if I was facing them as the counterparty, I'm like, I think that the US government will have to fail before JP Morgan fails. I mean, when you think about digital capital is invisible, right? It's intangible, it's immortal, right? It's indestructible. But while you're working through your bulls, like comparing it to a building, it's all those things. It's musical. And the musical is something to think about, right? Think about a symphony. Think about vibrating the strings of a guitar, you know, think about, you know, energy, frequency, and vibration. And think about Mozart's or Beethoven's 7th Symphony or Beethoven's 9th Symphony. Think about what happens when you start to vibrate on various frequencies, and literally you hear it and it's beautiful. And then think about how fast you can vibrate a building, and think about how fast you can vibrate a $1 billion block of Apple stock. And see, they don't play, right? They vibrate like a rock, right? You can't, right? The answer is you can't play that capital, right? You can't. But with digital capital, you can, you know, on the base network, you can move it once an hour. That's actually comparatively high frequency compared to moving gold once a year, right? What, 8,760 hours a year. So 8,760 times faster than the fastest gold. Seems like high frequency. But really, when you put it on a layer 2 network, the real point is if I can settle on the underlying network, then when you put Coinbase against Binance as a counterparty, or you put Block against, you know, set up layer 2 and layer 3 counterparties, they can move the stuff, you know, at 10 kilohertz on the weekend. And now you combine that with the, you know, high speed trading has been a fixture in certain equity markets, but we've never had high speed global trading. It's like asking me in 1650, are there risks in building Manhattan into a great city in North America? There's steps that have to be, you know, if I find you the greatest port in North America, you know, an island of granite sitting between the East River, the Hudson River, with the great natural harbor, right, in the right location, and everybody's decided it's their favorite city, and the year is 1650, are there risks with growing the city? I suppose, but I don't think of it that way, right? I just think there's challenges to be overcome and opportunities, right? And so I think Bitcoin's going through all that, right? There's stuff to be built. It's one thing to say banks should custody Bitcoin. It's another thing to create, you know, are 10,000 banks going to create their own Bitcoin custody service? Well, is that a risk or is that an opportunity? I guess I'm back to 1900 and I'm in New York, and we just invented electricity. And I'm just pointing out that I think like one day all buildings will be wired with electricity. And you're asking me, are there risks in the wiring of New York City with electricity? And I guess there's going to be some electric fires, right? And there's also going to be a lot of fire insurance to get sold. And there's also going to be electricians, and there's going to be electricians union, and there's going to be a lot of projects, and there's probably going to be a bond, and somebody's going to complain about it. We're going to dig a lot of trenches, right? Because where are those power lines running? And someone's probably going to put a drill, jackhammer through one of the power lines, and stuff's going to happen. And then we're going to fight over whether we burn coal or we run the power line to Niagara Falls. And there's going to be stuff, but I just think there's just a lot of work to be done. We're building out the future.